This is Scott Becker from the Becker Private Equity Business Podcast. Today's topic is 5 rules on investing per Peter Lynch. So for those that are my age, we know who Peter Lynch was. Peter Lynch was this sort of legendary investor at Fidelity that ran the Fidelity Magellan Fund for a very long time, 13 or 15 years, and had astounding results. I think an average return of 29% a year or something like that. Just did a legendary job. He wrote a book on investing called One Up on Wall Street, and then recently was interviewed by Yahoo Finance on both in the title of the interview is Fidelity Invest legend Peter Lynch. I never said to invest in the stock market, but that's not really the real. That's a great lead-in clickbait to read the article. But the article really goes through 5 or 6 points that Peter Lynch has on investing, and they're brilliant as Peter Lynch always was. So his first concept is know what you're investing in. And this is something we talk about often. Every once in a while, I invest in something as a fluke. It's just not really thought out why. I always lose on those, but at least to know what you're investing in, why you're investing in it. Second, he says that people aren't careful enough at all about investing, and many of them are, quote unquote, playing the market. And playing the market might as well be like gambling. And I think, again, a great take from him on playing the market versus truly investing. Third, for the companies that you're investing in, you really need to understand the company story. What are their growth prospects? What's their balance sheet? How much debt do they have? How much cash do they have? What are the trends in the balance sheet? Not that much information, but at least a couple core thoughts about are they healthy or not healthy, and sort of understanding their balance sheet, understanding their financials. Fourth, what inning is the company in? So is the company already in every single market where it's now moved maybe to a cash cow versus growth company? Or is it earlier on in its history where there's lots of room for potential growth? He looks at a company even like Walmart today and says, look, it's only in about 20% of the markets in the U.S., so there's still potentially room for growth. The last point he says, which goes to some of these other points, is to really understand your thesis as to why you're investing in the stock and to be able to explain why in 3 to 4 quick bullet points. So, for example, I could say that when I invested in Amazon or Microsoft, I invested because I had these hyper-profitable cloud businesses that might drive their value and profitability. In contrast, when I invested in Bitcoin and cannabis, I invested more so out of what we would call FOMO without any real great reason why. Those are 2 very different sentiments. One's at least a rationally sensible sentiment. One's a stupid sentiment. But this concept, the other concept he had was a diversification concept, that if you're going to invest in stocks, you got to be able to invest at least 10 of them, at least, and then have a thesis for each one as to why you're investing in it. In any event, I thought these rules for investing in this most recent article, Fidelity legend Peter Lynch, I never said to invest in the stock market, are really right on. I think he really has it. The only thing I would say differently is you have to understand your allocation of assets, stocks to bonds, risk to non-risk, and so forth in terms of your portfolio, as well as then when you're investing in stocks, these are great rules to follow. In any event, thank you for listening to the Becker Private Equity and Business Podcast. If you listen to this all the way through and you text me Peter Lynch, and you're the first person to text me today, I'll send you a $100 Amazon gift certificate, but you can't be somebody that regularly gets a $100 gift certificate. Thank you for listening to the Becker Private Equity and Business Podcast. Thank you very, very much for listening.